Hi everybody, Dave Aquino with Basecamp Trading. This is a free video for Monday, June 16th. So we are watching the 10-year Treasury bond. So this is the 7 to 10-year Treasury bond ETF. You can see we're a little bit weaker, but generally we've been range bound between this low at 93.5 and this high right around 94.5. Okay. Now, normally I don't look at the bonds themselves, but I do pay attention to the 10-year yield. This is a very important number when it comes to financial life in general. This controls the mortgage interest rates. It covers, it controls business loans, auto loans, everything revolves around the 10-year Treasury bond yield. So right now we are right around 4.4 and a half, right? 4.450. Okay, this is an ETF that measures it. You slide the decimal one place over to the left, 4.448 is what the current 10-year yield is. It becomes problematic for the markets if the yields spike higher. So what's happening is bonds are falling, yield is going up, basically making money more and more expensive. This also affects stock prices. It puts pressure on the stock prices as yield goes up. So if you can see across here, when the yield is significantly higher, it puts pressure on the stock market. The level we need to watch, this is in a consolidation area between 4.5 and roughly 4.33. Okay, 4 and a third. If we break higher towards 4.6 like we were about a month ago, it gets into a kind of a danger zone. We may revisit 4.664. Or up here is 4.8. 4.8 is getting dangerously close to 5%. And you can see this will put a lot of pressure on the market. The reason why we are looking at that is that when the Federal Reserve comes out this week and has their meeting, if they say things that worry the bond market, the bonds will sell off and yield will go higher. If yield goes higher, it puts pressure on the stock market. If the bond market is encouraged, the bonds will go up, yield will go down, and that will be less pressure on the stock market. So the 10-year yield is really important. Again, it definitely not only influences the stock market, but the general economy as a whole. It is something you have to keep an eye on because it has a tendency to trend. It's been in consolidation while the Fed has been on hold, basically, with interest rates. So what you want to watch is for any upward movement. Now, another thing that could affect this over the next months and quarters is the tax bill. If the tax bill gets passed and they don't address those 10-year projection on deficits, the bond market will freak out, for lack of a better term, and yield will spike. That spike in the yields will put a lot of pressure on the stock market. So just be very aware. Okay, right now we're just paying attention to this small range and watching to see which way it breaks Wednesday afternoon. Okay, thanks a lot.